So firstly, good morning and thanks everyone for coming along. My name's John Mulcahy and I'm the Advice Manager at LGIA Super, as some of you already know. And in starting, I'd just like to share a few images. As I say, we meet with a lot of you and hopefully these demonstrate how you like to spend your holiday, your big long holiday, your retirement. So I might get a bit of a show of hands here. So has anyone got grandchildren in the room? Yeah? So do you find that you apply a different set of rules to your grandchildren than maybe you applied to your own children? Yeah, it's good. There's a lot of honesty in the room, so I appreciate that. Definitely family is often very important. Anyone been on a cruise in the last 12 months? Yeah. Next 12 months? Yeah, and a lot of similar hands going up, because that's the other thing I find. People, when you're retired, do a cruise, you're hooked. So as a financial planner, if you haven't done one yet, don't do one, all right? But otherwise, it's definitely very popular. Anyone travelled overseas since you've been retired or plan to? Yeah, fantastic. Or enjoy travelling around Australia, because let's face it, there's plenty right here. And that's fantastic. And I suppose, as I say, the reason we put those images on, because we're regularly, a team of advisors and myself are regularly meeting with members just like you, and so we're hearing those stories. Sometimes it gets a bit depressed because, we are still working, but we just hear where you've been and where you're about to head off to. But that's fantastic, and that's why we're here at LGIA Super. Obviously, we want to partner with you and help you to enjoy retirement after putting in all the years to put yourself in that position. But at the same time, and part of what this morning is about, is to, I guess, highlight or warn you that there can be things that happen that potentially derail that. And so hopefully give you an information to just make sure you're always reflecting on your situation and know where to go for help and arm you with the information to make good decisions. Now, before I get into the good stuff, I'll just cover, I guess, an important legal matter. And some of you would have been to our seminars before, so you're probably well familiar with this slide. But I think it is important because we get here, we get a whole room full of people, and you all have very similar needs from your superannuation, but at the same time, clearly, you're all individuals and have different circumstances. So while we're going to stand up here and provide a lot of information, we've got no way of being confident or suggesting at all that it's all relevant to you. So it's information that we then encourage you to go away and apply to your own circumstances to determine to what extent it might apply to you, and of course encourage you to see us if you need further assistance. Now, the first thing I want to talk about, and I was talking with a lady here this morning who made this comment, things have been good. All right, so this is what we've seen for the last 10 years. Very strong returns. So that graph represents the diversified growth option within our pension fund. So it's virtually doubled since 1st of July in 2009. Now, sorry, can I just ask you another thing here? So can you just raise your hands for those people who are retired? Yeah. So leave them up, sorry. This is your exercise for the day. If you just leave your hands up, thanks. And just put them down as I get to how long you've been retired. So anyone just retired in the last 12 months? 2 years? 3? 4? 5? Between 5 and 10? Yep. So most of you are still on your apprenticeship, right, as far as retirement goes. And so how easy is retirement? Right? Many of you are probably only drawing the minimum from your pension, in which case you could well have more in your super now than you did when you retired. So easy. And if you've been in a pension account, those returns have been tax-free as well. Right? Fantastic. But the temptation, and again, I did hear this as well, I'm not going to single anyone out. It's been so good and all these returns, so there's more money. There might be a temptation to spend that money. Now, I am fairly miserable, and I don't want you not to enjoy your retirement, but I just want you to make smart decisions. So let's look at that for a while. Does anyone remember headlines like these? Yeah. Could it happen again? Yeah, absolutely. But more likely. It's just, reflecting on my life. So I recall the 87 crash, the recession of the early 90s, the tech wreck of 2000, and of course 2007, the biggest crisis in a century in the GFC. There was also an oil, Troy might help me here, there was also an oil crisis or something in the early 70s, but I was barely out of nappies for that one, so I'm not fully across that one. But, you know, these things happen regularly. And as I said, the last time this happened, as we just saw with those show of hands, most of you are still at work. So you're potentially going to be much more susceptible next time it happens than you were last time, because although you may have been concerned, clearly you weren't relying on your super at that stage because you had employment income in, or some of you might have even deferred retirement for a little while to give your money time to come back. And so I guess that's the point. We know it'll happen again. We just don't know when it'll be, what's the trigger going to be, and how bad it's going to be. So hopefully we can learn from the past so that when it does happen, you'll be as prepared as you can be and not minimise the damage, I suppose. So let's look at that a little bit closer now. So what we've got here is the start of the GFC, if you like. So from basically November 2007 through to what turned out to be the bottom of the downturn in around February, March of 2009. So I guess the things here for you to think about is, how would you feel if this happened next year? How would you react? As I said, I've been advising, well, I didn't say, I've been advising for a while, and I've advised for the last two downturns, and comments I often got from clients like yourselves who retired is, John, I can't afford to lose this money because I can't earn it again. And that's a very understandable mindset, but it's also a potentially risky mindset if it drives to bad habits or bad behaviour when these events happen. Because the temptation obviously can become more defensive in times like that, especially when, like the previous slide, we saw those headlines, the media just jump on it and all you're hearing is bad news. And as Troy will talk about in a moment when he gets up, our Chief Investment Officer, the risk of you losing all your money in a fund like LGI Super is basically as close to zero as it can get. So I guess the first thing I want to do is say that that's not a realistic possible outcome. So what is things like this, fluctuation in returns. So let's consider what many people might be tempted to do, and that is move out of the volatile investments that are being exposed by what's going on and into something more conservative than that. So what I've done is I've put up the return on the cash option in the pension over that same period of time. So if you can't see the numbers, the diversified growth in pension fell by just short of 30% over that time frame. Very, very significant. And cash did just short of 8% positive. Right. And by the way, does anyone know what the cash rate was in July of 2008? 7.25%. What is it now? 3/4. I mean, who would have thought? I'm not a gambler, but could you imagine the odds in 2008 of that? And that's the thing, we don't know what's down the road. But let's look at what the impact could be. So moving on a little bit further, and we can see here it wasn't the end of the world. Surprise, surprise. Markets did recover, and as bad as it was, we did get our money back. But it did take time, absolutely. So let's consider, what if during this downturn here, it just got too much for me? Because as I say, they're the calls we get. We've got to get out. So look, for the sake of example, let's say I could hold out for 12 months, but then I couldn't take it anymore because it was still bad news. I'd dropped 15%. I was retired, so I'd had to draw my minimum. I'd had to take 4 or 5%. So in actual terms, I was potentially down around 20%. That's significant, absolutely. So I couldn't get out. Sorry, I couldn't take it anymore. So cash was, as I said, 8%. I'll jump into cash. Now, clearly, for a while here, I was a genius, right? Absolutely, no doubt I've made the right decision. But quite interestingly, I think, by the time I've made up the losses, the market had made up its losses, it had also cut down any advantage that I'd had by being in cash over that time frame. And if we move forward from that, again, the people who held strong and stayed invested then also continued to benefit from the rising market that always comes after a significant downturn. And so to me, the point is, if you get out, you're creating a real high, and it mightn't be cash, it just might be something more conservative, but the cost to you can be very significant. And I guess another comment often when I'm having these conversations with people, or at the time of the downturn, people will say, well, I'll get back. I won't stay out. At some point I'll get back in. And normally what I say to them then is ask the question, well, when will you get back in? And usually there's dead silence like that. And so then usually I'll answer the question, because as you can probably tell already, I don't mind talking. So what I'd normally suggest to them is they're not likely really to probably get back in until they've absolutely satisfied that everything's better. And that doesn't happen until the returns have been achieved. And the market and the media are then saying, hey, record returns for the last 12 months and all of that sort of thing. So the point of pointing that out is, yes, you might get back in, but anytime you get back in, that gap between those lines is returns that you've missed out on. You basically can't get that back in. You can't get that back. And just a reminder, timely, I suppose, in preparing this, I was talking to a client literally in the last few weeks who provided advice to a couple of years ago. And in talking to them, I noticed that they were in cash. And that's definitely not why I recommended they be in. And so I asked them about this, and they said, oh, yeah, I know what you said, but I just was sure there was going to be a correction. It had been too good for too long. So they've been in cash for 2 years. That cost to them is easily over $100,000 compared to if they had been in the right, sensible strategy for what they were needing. And so to me, that just was a timely illustration of the risks of trying to take wholesale changes or take really strong positions, either aggressively or conservatively, based on what you think might happen in the future. But I still think we're still forgetting something here, and that is what came first, or what came before the correction. Because the other thing I find very interesting in dealing with people in downturns is nearly always they'll start to anchor their measurement of performance from the previous high water mark or the last high of the market, which I've tried to mark there for you. And as I showed you on that earlier slide, was around November 2007. And so the phone calls come into the fund and say, oh, it's down 15% or 20%. And you say, well, yes, it is, but I think you're forgetting something, and that's what happened before the correction, because markets don't just drop for the sake of it. There's generally a cause, and usually that cause is a build-up in asset prices or market prices prior to that too far. And really what the market is doing is borrowing from the future. And if you think of that in a graph, if you run a line through there, basically that peak there has really just is made up by the following trough, if that makes sense. So in those, between 2003 to 2007, markets were doing phenomenally well. Typically, a typical balance fund or growth fund in those years were easily doing 14, 15, 17% per annum, back to back for about 3 years. Okay, unsustainable, definitely unsustainable. And that's, as I said, it's about double the long-term return. And again, so people, hopefully, I don't offend anyone today, it's not my intention, but we're funny creatures, right? And fear and greed. So when times are good and those good returns are coming in, the phones aren't ringing at the fund to say, LJ Super, why are you getting double the returns that I should be getting, right? Don't want to know, just that's what 13%, 15%, 10% in current markets, yeah, that's great, I'll take it. But really, you should be asking the same questions. All right, well, if the long-term expected return is 5% or 7%, why am I getting 15? And hopefully, in asking those questions, you'll also know that, all right, well, that's not sustainable, and similarly, it can go the other way. And the other temptation for people at times like that, of course, when things are going well, is, oh, maybe I should put more money in. And that's also risky. So I guess what we're talking about is, really the main point I'm trying to make out of all this is not to be a scaremonger, but to suggest that if you consider your situation, your comfort levels, what you need from retirement, and choose investment strategy that's appropriate for that, then when these events happen, you shouldn't need to make wholesale changes to what you're doing. As much as that's not going to make it be enjoyable, hopefully it just helps you know that you'll be all right, and if you hold the course, you'll be paid off in the long run. Now with that, I would like to obviously I do need to stop talking for a moment, invite Troy up to the podium to explain a bit about LGI Super's approach to investment and a bit of an outlook. Thanks, Troy. Oh, don't clap me yet, because you're going to have me back. So,
Yeah, you're not done with John yet. Thanks, John. There we go. Yes, that's a pretty picture of me. Thank you for your time this morning. I'm very happy to take questions. We're going to be here all day. I have some slides prepared here, but what I want to make sure that everyone understands is that if you do have questions, I'd very much like to answer them. So what are we really trying to do here? On your behalf, we're trying to generate strong and consistent returns. Generate the income that you're going to need in retirement to live the lifestyle that you deserve. How are we trying to do that? Well, we're not trying to second-guess markets. That's one of the great temptations in life, to forecast when the next recession's going to be. Will the share market double next year? Will it halve? We do move our money around from time to time to take advantage of opportunities, but our biggest friend and our greatest weapon against risk is diversification. That's what we do. We build these diversified investment portfolios on your behalf because diversification is the most effective form of risk management. And then what we do is offer you various risk profiles along the spectrum, for those who are very conservative to those who are happy to take a lot more investment risk. If you would like to build your own portfolio or have an advisor do it for you, we also offer our single sector options. Given the size of the fund, we think there are a couple of areas where we have an advantage over, I'll call them the mega funds, the $100 billion plus sized funds. We're really looking for assets in what we call the mid-market. For some funds, they can't get out of bed unless they've got $1 billion investment opportunity. Right? And I sympathise with that. For us, if we can find assets with development opportunities, $50, $100, $150 million, we can put that money to work very quickly, and we're happy to take on the project and development risk that goes with it. So we think there is a niche out there for funds like us who can put smaller sized checks to work on your behalf and earn those extra returns that we're going to need. Here's one good example, the Sunshine Coast Airport. We own about a third of this on behalf of the members of the fund. We currently have about $30 million invested. That's rising towards $50 million in 2022. It features another one of the great things about the fund, that we do like to partner with local communities in Queensland. We're a Queensland-based fund. Right? We see plenty of investment opportunities around here. We do very much believe in diversification, but where we can find really good assets in Queensland, that's our preferred approach. So the Sunshine Coast is ideally positioned to take advantage of the increasing retirement demographics that we see in Australia. It's also well positioned for tourism. Right? There's been a massive increase in tourism numbers from China in particular, but also places like India in the last 10 years. So we've been able to partner with a couple of other investors here, put some capital to work, invest into an asset that's going to be growing quite quickly over time. We're looking at an 18% return so far in this investment. That's fantastic. I want to find 20 more of these things. What else have we got? I've just come back from a trip to the US to investigate one of our assets here. We have about $100 million invested in a US greenhouse strategy. Now, my folks live about 4 hours north of here. They grow their own vegetables. They've got lettuce in the backyard. This is 2.5 acres of lettuce. Revol Greens facility in Minnesota. Expanding from 2.5 acres to 10 acres on its way to 22.5 acres of lettuce. That's a lot of lettuce. And I can tell you it's several football fields wide. Outside, Minnesota at this time of year is sort of minus 13 to minus 15 degrees Celsius. Yes, it's pretty cool. Inside, it's a really crisp 23 degrees Celsius. The strategy here is very simple. In the US, they face a great challenge with food security. You occasionally see these notices come through about romaine lettuce and salmonella poisoning. There was an incident about 3 months ago where every single romaine lettuce in the United States had to be removed from the shelves of supermarkets. Within 24 hours, the lettuce from the Revol Greens facility here in Minnesota were back on the shelves. Food security is a huge issue, but it's also about the reliability of supply. For supermarkets in the US, they are paranoid about the Amazon effect. One of the few things that they can do here to draw people into the store, to get the foot traffic going, is offer high quality fresh food and veg. Amazon hasn't been able to do that yet. They're trying with Whole Foods. So the facility here in Minnesota, along with others in Mexico, California, Arizona is under expansion at the present time, in Texas, are trying to capitalise on this increasing focus in the US on food security and food dependability. They also happen to be very efficient from a resourcing point of view. They use 90% less water than traditional outdoor growing methods. They co-locate with a power generation facility here to capture carbon dioxide. They pump that carbon dioxide into the greenhouse to boost the growing rates. Right? Our returns here on the $100-odd million invested are north of 15% per annum. Right? This is a great asset, and it's still growing. It's still growing. We also have money invested in wind farms here in South Australia, the Waterloo project. Right? Returns on this one are also in the mid-teens. Yes, there are environmental benefits, but this is a classic piece of infrastructure. What do I mean by that? Find an opportunity in the marketplace, partner with an experienced developer of the asset, then lock down the risks. And what do we mean by that? Sign up to long-term take-or-pay contracts, 10 to 15 years on the power offtakes here. That generates long-term and stable cash flows, which is great for, particularly in the pension part of the plant here. We love these stable assets with simple operating models that generate cash flows forever and don't require high margins to operate. These are the sorts of assets that allow us to generate the stable return streams that you're looking for here. So we need to generate returns that are sufficiently high, but we're also trying to smooth out the ups and downs that you see with the share market. Share market investments are great. I love them. I use it myself personally. But we need to complement that with other assets in the plan. So we do invest in real estate, infrastructure. We have some money invested in alternatives and bonds. We have specific assets here like the wind farms. Right? Trying to smooth out the return profile over time. Right? We very much like Queensland-based assets, and we've got a selection of them here listed on the screen. Got a lot of retail assets there, of course, commercial buildings. We've got some specialty medical centres coming down the pipeline here. Again, one of the great trends in society, the real boom that we're seeing here is longevity. People are living longer, and that's a wonderful thing. But it also means that their healthcare needs are increasing over time at a much higher rate than GDP. We like to think about this as one of the ways that we can do good as well as doing well for members in the fund. In addition to these assets here, we've done a deal with the Village Roadshow theme parks on the Gold Coast, the Sunshine Coast Airport we've already spoken about, regional livestock exchanges throughout the state, right? Macadamia farms. We're happy to look at very different sorts of investments than traditionally used in superannuation, and if they're in Queensland and the returns are great, even better for us. So we turn our minds to the future, and you will hear a discussion about the R word, recession. Many of you remember the last time we had one of those things here in Australia, back in the late 80s, early 90s. I was still a very young and thin man at that point in time, running around in short shorts at university. We haven't had a recession here for 30 years. We have literally been investing in awesome times in Australia. But I don't want people to walk away from here with a deep sense of concern about that. Right? As John points out, if you spend your life worrying about the next recession, the next downturn in markets, first of all, you're not enjoying your retirement, which is terrible. And secondly, you can forego a lot of investment opportunities in the meantime. When you go and have a look at the return streams over time, some of the best times to invest in markets are those periods leading up into, I don't want to use the R word, strong downturns in the economy. But there are some longer term challenges in front of us here. And the big message I'd like you to all walk away with today is we're up for that challenge. We'd love to work with you in the future for the next 30 or 50 years on this challenge of delivering the suitable investment returns you're going to need to live your life in retirement. Here in Australia, you can look in that top left box, a bunch of rectangles. The rectangles are getting lower over time. We're maturing here as a country, not just demographically, but also economically. Growth is slower. Growth is slower. Right? And we're having this big shift away from manufacturing. We've seen particularly a trend here in Australia to lose, for example, our car industry. It's much more service-oriented. Two of our three biggest export industries these days, education and tourism. Right? It's a very different world to when I started growing up. But the big message I want people to take away from this chart is that the world is very much under change. John mentioned term deposit rates and cash rates. I remember making my first term deposit at 18% back in the late 80s. Now you can barely get 1.5% for a term deposit. And a big change here for us in Australia is that inflation's a lot lower. So there is an upside to this slower growth environment. Inflation's no longer the challenge that we were seeing 10 to 20 years ago. We are a much lower inflation economy. That means the purchasing power of your dollars stays in your pocket a lot longer. So even if returns are lower in a nominal sense, in a real sense, they haven't fallen anywhere near as far. Right? That's really good, because for those of you who haven't quite reached that retirement phase yet and you have to pay tax on the inflationary bit, I hate that. That drives me crazy. The real challenge, I think, for us here is in that bottom right-hand box, and that's large levels of outstanding debt around the world. And again, it's a good news, bad news story. Right? The good news here is that we still have capacity in Australia as a government, both state and the federal level, to expand our debt if required. So if we did face an economic downturn here, you know that the state government and the federal government can spend more money and help us work through those weaker economic times. I can't overemphasise how important that is compared to other countries around the world. We have an incredibly low level of government debt here compared to other countries. That's going to be a real benefit at some point in the future. Cash rates, unfortunately, for those of you who like term deposits, are going to stay low. And that's the flip side here of the outstanding debt story. It's very hard for interest rates around the world to rise materially when there's so much outstanding debt. But again, it's a good news, bad news story. Low cash rates mean more, low costs for borrowing as well. So for folks like us who can take a long-term perspective on your behalf, we can borrow money at relatively low rates, put in reasonable hurdles, and buy these good quality assets to generate 8 to 10% per annum. Complement that with cash and bonds to help stabilise the return streams over time. Right? So I think the future environment is going to be more challenging than it has been in the last 5 to 10 years. Again, John mentioned the GFC. And the big challenge for us all is to avoid that headline risk, because you'd never see that $50 billion wiped onto share prices headline. That doesn't sell newspapers. It's to focus on the income generating capacity of your money. So even if the account balance does drop, the ability of that account to generate ongoing income doesn't fall anywhere near as much. And that's something we don't talk enough about. It's something we don't talk enough about. So it's a big friendly don't panic from me here. We think that the future environment is going to see lower returns than we have generated historically, but we accept that as a challenge. Challenge accepted. So I'd be very happy to take your questions. We know that there's lots of uncertainty out there. Please don't panic. Most of the time this uncertainty amounts to nothing. I've certainly just come back from the US feeling more positive about the next 3 to 6 months. I'm hoping there's going to be a trade resolution between the US and China. I'm hoping at some point that Brexit gets sorted out one way or another. And if we see both of those events fall into place heading into the presidential election cycle, this could actually be a really good 6 months for markets. That'd be great for everybody. Thanks for your time. I look forward to taking your questions.
Yeah, thanks, Troy. It's great, I think, to be able to hear from the man at the helm who's guiding the ship, and hopefully reassuring to know that there is some science and logic and deep thought behind what's going on behind the scenes. But again, from the advisor's perspective, we know they're looking after that, so we're more worried about the interface, if you like, with yourselves. And so just in rounding out this investment section, I guess I'd like to just reflect on what those options are for you, because at the beginning of the session I was referring obviously to our diversified growth option throughout all those graphs. Now that's not to say that you should or should not be in that option. It was just the example, and because many of you are, of course. So what we like to do as well though is point out that at LGA Super we also recognise that while you all have similar needs from your super, as I said at the start, you're all different, and so there is definitely no one size fits all. So what we do have is a range of options though that we know will meet the vast majority of you will fit in there somewhere. Now, so hopefully you can all read it, but basically these are what our diversified options. Troy mentioned there's also some single sector, so if you've got particularly strong views and you want to have tilts with different shares and property or cash, then you're able to do that. I guess as advisors, we tend to stick more with this because those allocations between all those underlying assets are being managed for you behind the scene. So that takes that pressure away from getting that timing wrong, and ranging all the way from aggressive through to defensive. Myself as an advisor, particularly with retirees and people approaching retirement, I'm actually quite a fan of maybe not just being all in one option. Why do I like that? Well, because definitely once you're retired, things are a bit different, because for most of you, that means you are needing some of your super right now or every fortnight to help with meeting your living expenses. So that is about a shorter term investment time frame as you can have. But at the same time, most of your super hopefully is still not needed for 5 years, 10 years, and maybe even longer. So what breaking it up allows us to do is maybe select from something at the more conservative end of the spectrum, or even cash, and having an allocation that means if that downturn does happen sooner rather than later, at least there's a bit more protection for you, knowing that the money I'm going to need to spend soon is not going to be affected or as affected as the rest. But meanwhile, it still allows you to have maybe the bulk of your assets still invested in more growth-based options, such as at this end of the scale, knowing that if a downturn comes, by the time you're likely to need that money, as we showed you on those earlier slides, markets can return and the value can be back there. So whether you use that approach, as I say, that can be very, very suitable. It's not to say a single option isn't suitable, but I guess my message to you today, if you do prefer a simpler strategy and one option, then really the key is making sure that you're in the right option for you, so that regardless of what's going on in the markets, you're going to feel comfortable to stay on for the whole journey. And so with that, I guess you might have some homework to do if you don't really look. I know, again, as someone suggested to me earlier, that they check their balance quite regularly and suggest that maybe they don't look at it as often when it's going down. Definitely I encourage you not to look at it too often, either way. But if you're not really understanding, to me it's make sure you understand what you're actually investing in and what to expect. Okay, and if you're not sure and you need help, that's what we're here for. Now, I'm just going to step aside from superannuation for a moment, because there is more to retirement than super, and aside from travelling and having fun, it might also mean age pension, for example. Now, most of you here, you said you're already retired, and so most of you probably already know whether you're getting the age pension or not. But I just wanted to cover a few points, because occasionally, and it's not that uncommon, my team and I will sit down with people who might be about to retire or have actually been retired already, and they're very sure that they're not entitled to any age pension. But once we have that conversation and explain the rules and understand their circumstances, sometimes we can actually say, well, it could be an entitlement here. So again, we want you to make sure that if you've got an entitlement, you're benefiting from it. So these are the three key things in determining that. First of all, age test, very quickly, it's currently 65 and a half. Okay, so if you're that age or more, you've already reached your age pension age. Then if you're born after 1953, your age pension age is going to be either 66, 66 and a half, or 67. Then they do a couple of tests. So once you've hit that age, then you can consider applying. And then the government looks at it, applies an asset and income test to see whether you get anything. So they apply both tests. If you fail under either of them, then you don't get one, or whichever one gives you the worst outcome, that's the one that gets applied. But I'll start with the asset test, because the asset test is usually the one in most cases that does affect people. Now, the numbers on the screen, you can see single and couple, and they're for homeowners. So there are different numbers if you're a non-homeowner, and those numbers are a bit higher to reflect that you don't have that value of money in the house. And I'm not going to dwell on this too much, other than to say, what's an assessable asset? Well, pretty much everything other than your home. But there is one, as a planner, I would suggest significant exception to that rule, and that is assets or money that's in an accumulation account for someone who's not yet age pension age. So that might be relevant to someone who's under age pension age and not working, or also if you're a couple and there's maybe a difference in ages, so one of you is going to hit age pension age before the other, then there can be potential to legally hide money from the government, if you like. So quick example, let's say spouse number 2 is only 63, so has a few years to go before they're going to be age pension age. So if they've got $200,000 in super, if that $200,000 is in a retirement pension account, the government's going to count it. But if that $200,000 is sitting in an accumulation account, not yet in a pension phase, even though they can still access it, it's not counted as an asset. So it's some planning opportunities for us, possibly, especially as I say, with couples where there's a few years difference, where you might be able to either get some or more. And then sometimes we can even help people get full pension for a period of time. So that's one thing to just bear in mind. And if that's you, it could be well worth seeking advice. Then they also do an income test, and at the risk of making an outlandish statement here, I would suggest these are pretty generous numbers. So you can see there for a single person, 53-odd thousand, and for a couple, you don't get no pension until after $81,000. And the really important point to understand with this one is that doesn't mean how much you're drawing from your superannuation pension, because the government applies a special rule on superannuation money, or all what they call financial assets, so money in super, bank deposits, shares, so what they call financial assets. And that is they don't actually care what return you're getting, they pretend that you're getting a certain rate. So for example, you might be drawing $30,000 a year from your pension account, but under deeming, only $10,000 might actually be what counts for that. I'll talk about it a bit more in just a moment. But one little warning there, so for anyone who has been retired since before 2015, there is some older rules in place for pension accounts that were in place then. So definitely, you should, if you're thinking of making any changes or looking at it, you should understand those grandfathered rules that apply to you. So that's sort of the age pension. Is there anything else? And that's the healthcare card. And this is one I definitely find most people don't understand, and that's very understandable. But while the asset test and the income test apply to whether or not you get any age pension, so this one's the Commonwealth, we're talking about the Commonwealth Seniors Healthcare Card. So this is the card that you can only get, again, once you've attained your age pension age. To get this one, there's no asset test, only an income test. And the income test is for a single $55,000 and for a couple $89,000. Right? And again, it's not the actual income necessarily, but deeming. So just something to think about here. So does anyone know, so I've sort of explained deeming. Deeming is where they pretend. Does anyone know the current deeming rates? They recently changed for the first time in a long time. So they're 1% and 3%. So basically what deeming is, you've got a pool of financial assets and the government says, and depending on whether you're single or a couple, they go, all right, well, we'll assume you get 1% on this much money and we'll assume you get 3% on the rest of it. And that's what we'll count as income. We don't care what you're actually getting as return. You can be getting 10%, they don't care. And they don't care how much you're physically drawing on a pension account. So on those current deeming rates, that means a single person, retired, could have as much as $1.9 million in financial assets and still get one of these. For a couple, that number is almost $3 million. I remember there was I'll talk about it now. Centrelink have a service called Financial Information Service. Has anyone used that previously? A couple of people. And look, if this Centrelink stuff, after what we've mentioned today, you're starting to have questions as to whether you're getting all that you're entitled to, we definitely encourage you to obviously talk to us, but also talk to them. They have their purpose, we call them FISOs, Financial Information Service Officers. Their job is not to try and not let people get government benefits. Their job is to sit down with people, understand your circumstances and explain what you may or may not be eligible for. If you've got a pen, if you want to know that you do it, you can ring 132 300. We can give you that number later, but 132 300 is the number to ring for the FIS service. And I remember doing these presentations many years ago, and one of the FISOs used to joke that he reckons Kerry Packer probably had a healthcare card because it's well documented that he didn't pay very much tax, apparently. So make sure about their healthcare card. That is, as I say, often one that we sit down with people and they've just gone, well, we don't get the age pension, so that's it. Well, no, you're probably still entitled to that. There's also one called a low-income healthcare card. So if you have either voluntarily or involuntarily retired before your age pension age, well, you won't be eligible for that one. You might be able to get the low-income healthcare card as well. Now, I'll just jump back to super now. Because the other thing we find in talking to people is, you're retired, so does that mean the doors are shut on super? And it might, but maybe not. So let's start at under 65, because sometimes we meet people who are under 65 and they think, well, I've retired, therefore the doors are shut on super. Well, no, super rules, 65 is a key age there. So regardless of whether you're retired or not, you can potentially contribute right up to 65. Yes, there are contribution limits that apply in that situation. So whether you still can or not will depend on contributions you've made up until now. What about after you turn 65? Too far, giving it away. After 65, it definitely gets harder. Anyone heard of the work test? Yeah. So with over 65, if you're still working, definitely if you're still working full-time and significant part-time hours, then yes, the door stays open for as long as you continue to work. So that work test, or what you need to meet the criteria, is 40 hours of work within a consecutive 30-day period within that financial year that you want to make a contribution. Okay. Now, a recent story, I had a couple of clients ring me just in the last few months because, and they're both in their early 70s now, but sadly there was an inheritance, and they were hoping to get most of that inheritance into super if they could, because they only needed a little bit to do some other things. So in having that conversation, and they'd been retired for quite a few years, so in having that conversation with them and explaining those rules, I left it with them. And then a few days later, they rang me back and said, John, our son-in-law has his own business and he can hire us. So they were able to legitimately meet the work test and open up the window so they can make the contributions that they want to get some of that inheritance into super this year. So again, if that's the situation, if you've got funds outside or you might want to look at, obviously not everyone's going to be able to meet the work test, but just look into that. Now this is the new kid on the block, and this is known as a downsizer contribution. So again, this applies if you're over 65 and you might be considering selling your family home. And again, that's not uncommon for us in having our conversations with clients who are retired or close to retirement. And they get to that time where they say, John, it's too big, kids don't visit anymore, it's a lot of cleaning, or there's stairs and I don't want to do stairs anymore. There can be a whole raft of reasons that they might then be thinking about selling the family home. Now, previously, that's great, and if you freed up any money, you had to find another home for it. But what this new rule does is let you get up to $300,000 per person, so for a couple, potentially up to $600,000 into superannuation after the age of 65 and without having to meet a work test. So if you find yourself in that situation, definitely look into it. Now, probably unsurprisingly, there's quite a list of rules that go along with this. Probably key ones, as I've already mentioned, you've got to be over 65, had to have had the house for at least 10 years. There's time frames, so you must do it within a certain time frame of the sale and so forth. So that's why I can't stress enough, if that might apply to you or you're thinking of selling, make sure you have a chat and get some advice before you go ahead, because there's no good selling in July and then at the end of the financial year thinking, oh, we'll put this money in now because the door's shut. So before we open up for question time, I'll just take you through a bit of an example that we thought might be relevant in this situation. So all we've done here is said someone retired at 65, a single person, they had $276,000 in super, and they needed $45,000 a year in income to enjoy the retirement that they want. So what the graph shows you is that was working really well for the first period of time. Sorry that they don't have the ages at the bottom, but basically where that income, so the green lines, I should point that out, so the bars there, that's the income measured over here, so you can see 45,000. But just before age 80, the super's basically been utilised under this example. So while they've been entitled to the full age pension all the way through, that means once my super's gone, then I'm fully reliant on the age pension in this example. So that's a drop of about $20,000 a year. So that's a significant hit to your income. Now you might say, well, I'm 80 and I'll be happy enough with that. Maybe so, but interestingly, some of the research and surveys that go on actually demonstrate that while most of us think that way, yeah, we won't be as active and our costs will go down with cost of living and particularly things like healthcare, we can find that those costs don't necessarily drop as low as you might think they would. Okay, so again, that's not a terrible outcome. But what if at 74, well, I've decided, yeah, I don't want this big house anymore, I'm going to make a change. So in this scenario, we've said, all right, well, I've sold the house, and after making my new living arrangements, I've got $200,000 left over. So under this downsizer rule, as long as I do that within the 90 days of selling, I can inject that into my super. So you can see there, I get the uplift in the balance of my super, which then allows me to maintain my preferred income level. And this is also shown in current dollars. So that means maintain in real terms all the way in this scenario now through to about age 90. Okay, so that I haven't done that to say at 74 you should sell your house, right? Live in your house as long as you like, but just so you know, at whatever point in time that might come up, it could be a strategy or something worth investigating. Now with that, as I say, we'll do some questions. Just before, look, continue to spoil your grandkids, but not too much. Continue to go on your cruises, but not too many. Continue to travel abroad and around Australia, but not too much, you know. You always got to think about the future. But I guess as we're saying, enjoy yourself, but maybe just make sure that you do spend enough time considering the financial side of retirement. Obviously, you're here today, so I'm probably preaching to the converted, because I think as long as you are checking, so, you know, don't necessarily remember when things are good, markets are borrowing from the future, so that doesn't mean I can spend whatever I like without having implications later. And if you need help, come and see us. With that here today, we've got the advice team. Are they all standing? Lovely group over here by the green table. So come and see myself or the team afterwards. Happy to talk to you individually. If you might like an advice appointment, we'd be happy to book you in. Or similarly, like you can see there, we've got these cards. You can feel free to fill out one of those and leave it with us, and we can get in touch about discussing what's relevant to you and possibly making an advice appointment. So with that, Troy is happy to join me, and just if there's any questions. Actually, while you're thinking, sorry, I know you thought I was going to shut up, just put your hand up and one of the team will come to you. One thing I did want to mention today, and given we've got time and it might preempt a question, is especially in retirement and with a super pension account, what happens when I pass away? Okay, so the fund doesn't keep the money, the trust, the board don't get the money, it still goes to the estate. But what's really important, I can't stress enough, is making sure that you've made adequate direction to the fund of what you want to have happen. So in the worst case scenario, if there's no nomination, then the trustees have a legal obligation to investigate to find out, well, who should get that money. And that can take time, and it can get complicated, and most likely the money would still probably get to who you wanted to get to, but it's going to take time and hassle. So there's two things I would really encourage you to consider. One's a reversionary nomination. Does anyone who started a pension have a reversionary nomination? Yeah, a few people know about it. Excellent. So the beauty of those is they're only relevant if you're in a couple, and you must do it at the start of a pension when you start the pension account. But basically that just means the owner of that pension account, if they pass away first, then the account basically just flows straight over to the survivor. And sadly, I've had two clients who have had to help through that this year. And the good thing, or I guess what made me feel a little bit better about playing a part in that, we were able to transfer that to their respective wives really quickly and easily. And when they're dealing with enough, that makes that a whole lot easier. But not everyone's married, or you might not already have a reversionary in place. So an alternative is a binding nomination. Okay, so what a binding nomination, as the name suggests, basically takes the obligation away from the trustees and ensures that that money goes to who you've nominated, as long as it's one of the people who it can be: spouse, children, legal personal representative, or someone with an interdependent relationship. And the other thing to note then, I'll shut up for a second, they do lapse every 3 years if you've got a binding nomination. Now, we will contact you and say, that's about to lapse, suggest you do a new one. But yeah, if you're unsure, it's been a while since you've done it, just revisit your member online and see what you have in place. Question, thank you.
Yeah, I have a question. question on, I don't know how to use this, on downsizing. What happens if you've already downsized and then for medical reasons after that you have to sell? Medical reasons. I'm saying if you've got stairs in the place and you happen to fall down the stairs and you find that, you know, you can't do it anymore and you advise that you have to sell out and go to how does that go with the super?
Yeah, good question, and I won't pretend to be able to answer that for you, to be honest. The rules, the main rules mention that 10-year rule, so I would need to see whether there's any allowance for a variation on condition of something like that. But it's still, you know, not trying to make excuses for myself, it's still fairly new, and I personally haven't had to go through that exercise, so we're happy to find out for you though. Yeah. Sorry. Yep.
Yeah, hello. Actually, my wife would like to open a superannuation account with you. She's 69 years of age. She meets the work test.
Does, yeah.
Because she's still working. She has inherited an overseas sum of money as she sold a property overseas. Mm-hmm. Now, I was told when I rang up and I asked about this, and they said, hey, you can't use that overseas money to open a superannuation. I said, what are you on about? Money is money. I don't care if it comes from overseas or won it in the lotto, or like her money that comes in from overseas, just say it's about a 200,000, she wants to stick it in her super. Well, I could say, well, hang on, that's your 200,000, I'll swap you my 200,000 for your 200,000, and we'll put my 200,000 in your super. What's the damn difference?
Yeah, look, if you've sold the money and brought it back into Australia, then where it originated from is really irrelevant. So I'd agree with you on that. She's still working. She can create an account. So yes, she should be able to. The question mark is probably whether she can get it all in, because over 65, the most you can put in as a voluntary contribution is $100,000 a year. So if that's more than that, she would need to meet the work test for multiple years to be able to get more than that into the fund. But yeah, look, it's not a question, obviously, we'd get too often.
Yeah, but I was actually told, point blank, by one of your people, even 100,000, if it comes from an overseas sale of a property, you cannot put that into your super. Now, was I told incorrectly or what?
Well, yeah, I would say you were, but
because I couldn't get my head around that. I thought money's money.
Yeah, we would agree, and we wouldn't have given you the answer not wanting your money. It may have been a misunderstanding, or they might have been concerned with foreign currency into Australian dollars or something. I wasn't part of the conversation, so I don't want to try and pretend. But if you've paid whatever tax, if you brought that money into Australia and you want to contribute that into super, as long as you meet those contribution rules, no problem.
Okay, it's a goer. Okay, she could put 100. She can open up a super account, and she can put 100,000 in, irrespective of where it has come from. Providing it's not drugs or anything like that or whatever.
Yes, there is.
It's okay.
Any money laundering, but
money laundering, yeah.
Look, obviously, I can't give you 100% yes without knowing your situation, but
I want 100%.
If you tick all those boxes,
she wants to know, so I really need to know.
Yeah. So if you want to chat to one of our team individually as well afterwards, they'd be happy to just work through that with you.
Okay, thank you very much.
Yeah, you're welcome. Thanks for the question.
I've got a bold but simple investment strategy question. For overseas investment, wouldn't we say it's wiser and safer to keep our money invested only in Australia?
What a perfect question for Troy.
It is an interesting one, isn't it? We do like the legal jurisdiction here in Australia. The rule of law is very sound. The challenge we have, of course, is that Australia is a very concentrated economy, and we're increasingly dependent upon China for a lot of our economic growth. So everyone knows about mineral exports, right? We're the biggest single customer for China. Tourism, there's been a massive increase in tourism numbers coming out of China. Everyone knows about residential housing, but even education. Education is now our third largest industry, something like 750,000 student visas. A large proportion of those come from China. So if we only kept all of our money here in Australia, when Australia does really well, we'll do awesome. The challenge is that at some point in time before I die, we're going to have another significant economic downturn. I don't like to use the R word. We haven't seen one here for 30 years. That's why Australia feels so much safer than other places around. What we tend to find is that there are opportunities overseas that we just can't get here in Australia. Even in a simple thing like the share market, there's no real equivalent to Microsoft, Apple, Google, Amazon, Illumina, companies that are just not on the Australian Stock Exchange. They've been fantastic returns for the fund the last 5 years. There's no equivalent to the greenhouse strategy that I can find here in Australia. So it's not just a question about diversification. We do like to spread the money around because it reduces risk on average. We see lots of opportunities offshore as well that we just can't find domestically. You're going to ask a question about foreign currency. Yes, we're very conscious about foreign currency exposure. It is a risk. It's been a big beneficiary to the fund in the last 5 to 10 years. Will that be the same in the next 5 to 10 years? That's literally a $64 million question.
Hello. I'd like to know a bit more about the property fund. I know on the risk scale that it's just as high as the share funds, and I wanted to know why was that, if it's mainly based on rental returns and sort of solid real estate.
Yeah, that's a really good question. So some of the information that we have to display on the website's regulated by APRA. And in particular, we want to make sure that when we invest into strategies that members have a realistic understanding of the return and the risk prospects. So I personally love real estate. I think it's fabulous. It's been an outstanding performer forever. There are going to be periods in which real estate does experience negative returns. So we don't want to underrepresent the risks in that particular option. So our property options are a mix of domestic real estate, so things like 101 Eagle Street down here, shopping centres in Toowoomba, commercial, office and industrial. We invest a chunk of money offshore as well, where we're looking for value-add opportunities. You can see the little stand on the other side over here. We did a story on that one recently. We also have a small amount in there, about 20% of listed real estate investment trusts to provide security and liquidity. So it's a mix of assets. Do I think real estate is going to continue to do well over time? Absolutely. The big challenge with it, though, is that it's a relatively illiquid group of assets. And this is where representing risk is an increasing challenge for a fund. Over time, I think those returns are going to be very stable, but there are going to be periods where we see negative returns. I think there will be fewer negative returns in the real estate option compared to the Australian equities or the international equities returns. But it's also going to probably be slightly lower than those over the long term as well. Risk is a really difficult thing to communicate, even for the regulators. They've been wrestling with this one now for a decade.
Thanks. So we might just take one more question here, and then, as I've said, there's plenty of people willing to take questions individually after that. Oh, sorry.
Two more questions.
Maybe two then.
Two more
sorry,
questions.
I missed you. No, you're all right. Ladies first. Oh, you're not allowed to say that anymore. Sorry.
I don't mind. When you were doing that graph before, can I just clarify, when you were doing the returns about in the other different funds and cash,
Yep.
was that based on the diversified growth only?
Yeah, that was the...
That was sort of all invested in that and doing that comparison, so that was the one it was invested in?
Yes, yeah. So all those earlier slides, the green line with the drop and recovery, that was all the pension option diversified growth fund.
Yes.
Yeah, and where the black line came in, that was reflecting what the cash option did for those periods.
I just wanted to be sure of which one you were talking about. Thank you.
Okay.
Yep. So other options will have either slightly higher or slightly lower return lines over time.
Yes, in your various options, you've got your little pies with the various classifications in there, and I know that inside those classifications, as you've explained, you're shuffling out investments and buying and selling or whatever you need to do in there. But how often do you change the little pies for each strategy?
Yeah, that's a really good question. So if you get across to the investment showcase, we've got some lovely complex charts, which I personally love and no one can read, which is why I don't put them on the slides anymore. The big question for us when we build these diversified options is we do have a very long-term perspective, right? 10 years plus. But we also know that over shorter time periods, 1 to 3 years, markets do change. So the big challenge for us at the present time is that the return on cash and the return on traditional government bonds is really low. So naturally, we're holding a lot less of those. If I think about something like diversified growth, then the strategic allocation might be 10. We're currently sitting at 6. Right? For things like the share market, we're a little bit overweight at the present time. I think it's going to be a slightly better environment the next 3 to 6 months than we previously thought. So we do move money around between the sectors. The really important thing, though, for you is that 90% of the answer is choosing the right one of those diversified options, or you or your advisor assembling the portfolio to suit your risk profile. We do move the risk profile around a little bit within the options, but if you go into a 75-25 fund, it's going to be about that risk profile over time. It's never going to be dramatically less or dramatically greater risk profile than that. We think we can manage a little bit of the risk and generate a little bit of return, but we want to be true to label all the time.
Fantastic. So thanks, Troy, for joining me, and thank you all for your questions. Thanks for your attendance this morning. Obviously, you're welcome to stay now. There's some more, a bit of morning tea, I think, so feel free to talk to the team, investigate the various tables, and thanks again.
Thanks, everyone.